India is looking to raise up to $10 billion through its first ever dollar-denominated foreign bond sale, says Finance Secretary Subhash Chandra Garg, a move that has credible voices on both sides of the divide. The budget also proposes to give foreign investors more opportunities in Indian equities and bond issuances. But the million-dollar question here is just how much appetite do the foreign fund managers have for Indian issuances? Let's ask Taimur Baig, Managing Director and Chief Economist, DBS Group Research. Taimur, thanks very much for taking out the time. First up, before we get into the intricacies of the budget and what it lays out in terms of, the bond market issuances, the fiscal deficit number being brought down to 3.3%. Obviously, the key question lies in whether the assumptions behind the fiscal deficit projection are actually realistic, both on the revenue side as well as what they're trying to accommodate in terms of the RBI dividend. How have you factored this in, considering what they're expecting in terms of net tax revenues is expected to rise by 25%?
Right. Of course, those are highly optimistic assumptions. I think my starting point is that I don't look at the central government deficit in isolation. I look at it from a consolidated borrowing perspective. And given the states have been borrowing close to 3% of GDP, and companies like the Food Corporation of India have been borrowing something like 2% of GDP, to me, the fiscal deficit is something above 8%, not 3.4% of GDP. Unfortunately, the market narrative is focused on the central government because that is the number that the government presents. But when we are thinking about fiscal, its impact on interest rates, and the overall debt burden on Indian taxpayers, that would be the consolidated number. So the thing is that on the central government level, we have seen a gradual improvement in the fiscal deficit number over the last 4 or 5 years. We used to be in the 4.5 range. Now we're in the 3.5 range. But at that consolidated level, we haven't really moved much. So let's keep that in mind. And there is a cost to that because interest payments in various shapes and forms have to be serviced for that large issuance, not just the 3.3%. Now, to make the 3.3% math work, as you pointed out, you would need heroic assumptions on the revenue side and fairly conservative assumptions on the expenditure side. Therein lies the question that just like the few instances that we have seen in the past, a year from now, when the budget books are being closed, would we need to do some window dressing here, postponement of expenditure there to again meet this 3.3 or 3.4% number? And mind you, related to this discussion is the question that once India is subject to the vagaries of global market sentiment on the bond market, I don't think the bond market will focus on the 3.3 number anymore. If you're holding India's sovereign issuance of $10 billion, global market investors will actually think about the consolidated deficit and think of debt sustainability from that perspective.
Do you think that once we go and we tread that path, global vulnerabilities will impact us in a much larger fashion?
I think a very good case in point as a comparison would be Indonesia. They have been entering the global foreign currency debt market for a long time. They also have their local currency debt that is issued by the government of Indonesia, accessed by foreign investors. And you do see that the Indonesian bond yields tend to be a little more volatile, particularly the local bond yields, because foreign asset managers do go in and out depending on oil price, which is a phenomenon that is also seen in the case of India and also in the case of risk of fiscal slippage. So those developments, fiscal, oil, subsidy, those things, would become more and more bigger drivers, if you will, of bond yield going forward. And the government will not be able to hold the bond yield down with open market operations as they do now. So yes, some capital injection will come from overseas, so Indian savings rates will be supplemented by the global savings pool. That's a good thing, but it has to be balanced against the point that there might be a greater degree of volatility, and it would not be as controllable as it used to be in the past.
While we spoke about the tax revenue, what about the non-tax angle of it? The dividends, the divestment target has been upped. Dividend is very optimistic. I mean, obviously, we don't have the actual dividend number, but one of our colleagues did a story suggesting that it could be a much lower number that the RBI could dole out in the form of dividends. Is that also a slightly questionable number?
Well, there's a very short-term concern, which is the timing and the magnitude. I mean, both of those are a bit uncertain. So when we're in the new fiscal year, so we need the money to get some of the expenditures going. So from that perspective, you might actually see some monthly numbers disappointing on the downside if the dividend doesn't materialize very, very soon. And then, of course, is the question of how large or how small the dividend would be. Now, let's also remember that issues like disinvestment proceeds in international best practice is a below-the-line item. You don't consider that as an expenditure supporting revenue item because that's a one-off. What you sell today, you will not be able to sell again tomorrow. You'll have to sell something else. And also the quantity and quality of disinvestment is another question. So we have heard over the weekend that the government is okay reducing direct stakes in certain state-owned enterprises below 51%, as long as other government entities have a commensurate amount of ownership of those companies. To me, this is sort of neither here nor there. I think in the near term, when you hear the news, it sounds like a good thing that the government is stepping back, but the public sector is remaining involved. So again, when we talk about disinvestment, is it really, Peter taking some money and giving it to Paul when Peter and Paul both work for the government, or is it genuine disinvestment? I think is another issue. And I think, in the context of this, since I haven't really, given my view on the budget in general, is that I think the budget was a bit of a do no harm sort of a budget. It had a lot of pressure on boosting expenditure on the back of the election and rural distress, and I think it held the line there as much as it could, and we should commend the finance minister for that. But the complication around the budget math, around the assumptions, those don't go away. So it may be do no harm from a commitment perspective, but the math is still somewhat questionable, unfortunately.
Well, Taimur, I'll pick off a point from one of those, and which is the sovereign bond issue. Now, it has people on both sides, as our lead-in stated as well. We spoke to C. Rangarajan on Friday, and he was of the opinion that it's better to let foreigners bear the risk of foreign currency risk as opposed to the sovereign bearing it. There are equal and more number of people on the other hand who are believing that it's probably past time that India should do such a thing, and because it's a maiden issue, there is a lack of that paper in the international markets. It'll be subscribed well at a good rate, etc., etc. And a small issuance to start off with may not even be that troublesome for India, even if the global markets are a bit turbulent. What would your view be?
No, I think those are all very, very fair points. I think that if you were to join the global market in issuing foreign currency denominated bond, you could not have picked a better time than the second half of 2019. We've just had a major dovish turn among the global central banks in the last 6 months or so. Everybody's trying to outdove each other. So a large, stable economy like India, if it comes to the market and offers 4.5% in hard currency terms, I think you would have investors, sort of beating each other up to get a piece of that action. So I don't think demand should be a question. For the longer term, the question is to what extent do we see emerging market debt as an asset class doing? And India would be an important subset of that, but it'd still be part of the emerging market debt class. Is there a big pickup in emerging market debt funds around the world? Do we see global multilateral institutions or central banks or wealth funds increasing their allocation to global emerging market debt? The answer to that is a very qualified no. I don't think there has been a major change in the weightage assigned to emerging market debt. There hasn't been a major change in the way asset allocation has taken place with respect to emerging market debt in recent years. If anything, with all these geopolitical developments, particularly with respect to the U.S., meddling into a whole bunch of issues, the risk aversion tendency has been to actually become more overweight developed markets, not emerging markets. So this is something India doesn't have to worry about in the very near term. I think in the near term, given where we stand, the first subscription would be, slam dunk, no doubt about that. But this is something I think the government is thinking about as a long-term strategy, not just for 2019, but 2020 and beyond. Then one would have to deal with all these other issues. So the government, as a debt manager in the past, has been primarily concerned about Indian insurance companies and banks and others and their appetite and their capability of absorbing public issuances. Now the considerations have to be far more global, and there will be time when it will be very difficult to issue, much more so than now. But for the time being, I think we're okay.
I think we don't want to talk about equities. We'll do that as well. But I just have a follow-up on this, Taimur. What's your thought on the bond yields over the course of the next 6 to 12 odd months? Are we decidedly heading lower from where we are?
So there are several ways of thinking about it. If the economy has bottomed, as some government officials are claiming, I haven't seen much evidence of that, but let's go with that assumption. Then we might also see demand picking up and that having an impact, salutary impact on prices, which may make it hard for, at least from an inflation angle, bond yields to come down more. And also this question around the budget math, are the revenue assumptions too optimistic? Is the expenditure compression or restraint sustainable? I think those things would also start bearing into the issue of what the local currency bond yield would be. And then the rally that we saw on Friday after the announcement and so on, I can't imagine there is being significant additional juice left into it. And mind you, at least on the local currency bond side, India is not the only player in the world. There are other countries with large issuances that are also coming to the market that are similarly comparable to India with respect to debt dynamic and debt metrics, and some of them are even better than India. So it's a competitive field out there. India is an attractive market. There's a lot of goodwill foreign investors have toward India, but India is not the only story out there. Fiscal consolidation, disinflation, these things you see in a large number of emerging markets right now. It's not an India-specific phenomenon. So it's a crowded field, and in a crowded field where the fiscal math is somewhat questionable, I find it difficult to see significant additional room for the local currency bond yield to rally.
Historically, even if there was a fiscal expansion, but coupled with some amount of monetary stimulus, that directed rates towards the lower side. Now that there is no need of the fiscal expansion, and we've seen the number at 3.3%, how does that change the dynamics of the rate outlook and the overall monetary environment?
So I think from a rates outlook perspective, it's largely priced in. Everybody expects the RBI to continue cutting. Everybody expects the government, even in the coming years, not to deviate too much from this low 3% of GDP central government deficit, unless there's a huge spike in oil prices or something like that. So big terms of trade shock notwithstanding, I think the consolidation path is a serious and a credible one, and I think the market would reward that. But those things are expected and priced in, and given the rally that we've seen already, I cannot see significant additional room for rallying. If tomorrow the RBI comes and cuts by 50 basis points and announces very substantial amount of OMO, then of course, there is some juice left on the markets. But, you cannot have it in all ways. You cannot say growth is bottoming out, but at the same time, RBI needs to cut many, many times because there is a need for monetary support. It's one or the other. So in the case of if growth is very, very depressed and there needs to be substantial support from monetary side, that would also mean fiscal will deteriorate. So that's a negative for the bond yield, not necessarily a positive for the bond yield. So we need to keep this interconnected between the asset classes and the macro shocks in mind.
So at least from a near-term perspective, you expect the bond yields to stabilize at around 6.7, around this level of 6.7?
Yeah, so perhaps there is another 10 basis points, 10, 15 basis points of room left for further rally. I'm assuming there is no bad news in the pipeline. But beyond that, I mean, to me, it's, as I said, it's a fairly rich curve. Inflation seems to have bottomed out. There isn't much upside left from a macro news perspective in the near term. So, yeah, I think that neutral to mildly constructive would be an apt characterization of where I stand with respect to Indian bonds.
The other important part, obviously, was the government's push to improve liquidity for the troubled non-banking financial companies with the provision for partial guarantee. How positive is your reading on this development?
So, I mean, it helps. It helps, but at the same time, it's not an out-and-out guarantee. It's the government sort of saying that if the portfolios that banks purchase, in case of loss, up to 10% of them, the government will try to step in and smooth out the losses. So there are lots of ifs and buts associated here. You can, as a bank, just go out and buy some distressed portfolio. I don't think the government would support that. But the issue is really about the distressed portfolio. So I don't know if this framework necessarily changes that picture. It's about an NBFC that has unfortunate liquidity problems and therefore, for no fault of its own, it's struggling, and then the bank can come and give it support and the guarantee will then come and work. So solvency issue, I don't think this approach addresses liquidity issue, it does, and I think it sort of answers some of the calls that NBFCs have been making over the last 6 months or so, that in the process of the credit crunch and liquidity crunch, good and bad companies are becoming indistinguishable. Perhaps this approach allows the good and the bad portfolios to be distinguished. So from that perspective, one welcomes it. But let's keep in mind that the credit quality problem is a financial sector problem, not a bank or a non-bank problem. Banks saw NPLs materialize because credit quality worsened. NBFC stepped in to fill in the gap because the banks were not lending, but they were also facing the same group of creditors, same sort of macro problems, and now they're also beginning to see some worsening of their portfolio. So whether you think about the problems with the NBFC sector or the banking sector, I don't think they need to be considered in isolation. They're all part of the same bucket.
Taimur, there's a move to subsume FDI, FPI limits as well. There's also this talk of, or a proposal for reducing the promoter limit or upping the public limit in listed equities in India as well. What do you make of those from a foreign institutional investor's perspective? More supply and therefore maybe capping of prices in that fashion, or would you believe that, hey, more paper available and therefore more liquid a market and therefore positive from an FI's perspective?
So when I talk to equity investors invested in India, I don't see a very large group of sort of active fund managers any longer. I mean, I see a lot of passive investment which sort of follows the index, and there is a wait for India, and that comes in. So the index funds, if you will, I don't think there is any material change in the way. Now, you go into the world of hedge funds or mutual funds with active managers. From their perspective, perhaps the fact that there is greater float and there is more to play, on a structural basis, I think that makes India a more attractive market to participate in. But at the end of the day, it will really depend on the macro outlook, on company profitability and earnings. Those things, I think, will drive far more the inflows into India and to the enthusiasm of global fund managers, more so than just structural change on how much stocks are available to trade.
Okay. The other belief, I mean, one of your peers was with us today, and they've gone underweight global equities because of the pressures surrounding the US earnings, so on and so forth. In light of that, India may be a relative outperformer, but the quantum of gains might be limited in that sense, or might underperform slightly lesser than the other markets do. What's the base case from a non-bond market or an equity market perspective on India or the emerging market pack, Taimur?
So Niraj, the general point is that asset correlation across asset classes have picked up a lot. I mean, this is the days where equity market sell-off is countered by a bond market rally and vice versa. We don't really see that anymore. Look what happened in Friday after the US payroll numbers came out. Both equities and bonds sold off. And when developed market, particularly US and European markets, sell off, I don't necessarily see some sort of a flight to safety to emerging market equities. It would be nice if that were the case. That's the way you would like risk diversification to happen. If you don't like DM, you buy EM. If you don't like bonds, you buy stocks, and so on and so forth. But what we're seeing in this world of extremely low yield and a sort of low growth, falling earnings environment, everybody is basically waiting for the central bank to come and bail them out. So if the central bank doesn't come out and cut rates or inject more liquidity, it's bad for both equities and bonds. So we're in this rather perverse world, and hence the sort of strategy that you're suggesting, which should have been part of our rule book in the past, that if you are bearish the US equities, you should be bullish emerging market equities. It simply doesn't flow these days. Everything is going up and down at the same time. There's nowhere to hide, so to speak. So from my perspective, if somebody is concerned about US earnings and somebody's concerned about US growth topping out, they should be concerned about equity outlook globally in general, because that will pull everybody down, and there will be unintended consequences from US stock market selling off. Donald Trump might get very upset and start putting tariff on India. Who knows, right? We live in that strange kind of a world. So I wouldn't necessarily take bearish view on US to be translating into bullish view on India.
Very interesting that every view on equity markets across comes up with what Donald Trump could just do because he wakes up on one side of the bed versus the other side of the bed, isn't it? But anyways, okay. Taimur, one final question. So since the markets seem to be correlated by and large, what is your view? I understand that if somebody's bearish on the US markets, you should be bearish on global equities by and large. Next 12 months, different asset classes. What's your view, keeping India as the focal point?
I think that any country, if they can convince global investors and local investors, by the way, the local investors are also very important, global and local investors, that there is a cohesive macro framework in place, that the fiscal and the monetary and the structural, they are interconnected and the reforms are complementing one another, I think there is still dividend to be extracted out of that coherent framework. So we've seen the budget come out. Let's see what happens with monetary policy. Let's see with some of these far-reaching reforms where the government goes. Because as the macro narrative becomes more coherent, I am sure, as I said earlier, there's a huge amount of goodwill that India enjoys in the global marketplace. Investors will reward India. So on overall arching theme of assets classes being highly correlated, EMDM being correlated, that's true. But you can also argue that what is the best defensive case? If you're bearish global equities, which one will sell off the least? I guess one could argue that India should sell off the least. It's in a rate cut cycle. There are interesting structural reforms taking place, and the fiscal deficit, at least at the central government level, is stable. So I guess that would be the glass half full way of looking at it.
Right. Taimur, before we wrap up this conversation, a very small point that was mentioned, but an important one as well, is the fact that, RBI getting stronger supervisory and regulatory powers over housing finance companies, and the regulatory authority moving from the national housing banks to the RBI itself. I mean, how does that change, what's happening within the sector as a whole, and is this the right step?
It is absolutely the right step. This is in line with global practice. When you look at Bank of England, when you look at US monetary authorities, when you look at East Asia, increasingly central banks have taken on the financial stability mandate as a core part of their objective. And housing, as we saw in the case of the US 12 years ago, is a key part of that financial stability angle. If for whatever reason there is excessive lending into housing market, there's a huge run-up in housing prices, and that leads to a bust, that negative wealth effect has a far-reaching implication in many corners of the economy. So for the central bank not to have much supervisory ability or regulatory ability over that, I think is a handicap. So the fact that the RBI is becoming more emboldened in that regard, I think is very good news. They would have to build up capacity. They would have to hire very good people who are either from the private sector or from quasi-government sector with very good expertise, but they would be joining the canon of modern central banking by doing this.
Okay, Taimur, we'll leave it at that. Thank you so much for taking the time out and giving us your thoughts. Really appreciate your time this morning.
Thank you.
And viewers, on that note, let's call it a day on this leg of Indian Open, at least 1.27% down. So the Nifty Bank down about 400 points. It's not been a happy start, maybe better than the rest of the Asian pack, but we had a bit of a fall in Friday's session itself.
I think we dropped under 11,700, but I think just about managed to crawl our way back up. But let's see how the rest of the day shapes up. It's quite a bleed for banks as well, which are not supporting the index in any big way. But that concludes Indian Open. From Neeraj, myself, and the entire team that's put this show together, thanks a lot for watching. A lot more market action continues on the other side with the FNO Show.